folks, trading the figure. Alright, trading the big figure. Alright, the figure is just a term traders use to refer to a 100 pip or 100 point price level. Now some traders may refer to this level as handles as well. As an example, we'll refer to the cable as an example. A figure or a big figure may be in the form of 1.55, 1.54, 1.53, so 100 pip increment levels rounded to the nearest 100 pips. That's a big figure. There's a strong psychological relationship attached to these price levels, as well as option pricing and potential for stops to cluster at or near these price levels. Now, price can react notably at these price levels and mid-figure levels like 1.5550, 1.5450, or 1.5350. So the midpoint between the full figure or big figure, the 50% price, that is a mid figure. That's a psychological impact on the market as well. Alright, I know exactly what it's like, guys, to be a working trader. Okay, it can be rather challenging when starting out in trading. The daily responsibilities of being a spouse, a parent, and obviously an employee can make it very difficult and very hard. Having a macro perspective on the market and waiting for price to trade to these high probability levels such as the big figure and or mid figure, one can trade without having to be in front of the screens 24/7. Okay, so let's look at the basic big figure model. Here we have a support level, which is going to be represented by a big figure. Okay, and we have an upper level, which is going to be representing another big figure level. Now, this range from figure to figure could be as little as 100 pips. Okay, for instance, cable 150 to 151 for 100 pip handle up, and we're going to refer to a 100 pip price action in here. But when you're trading the figures, this range from low to high could be anywhere from several hundred to several thousand pips. Okay, so it's all based on what your time frame you're trading. Okay, but we're just going to refer to 100 pip basis in here. Price trades down to the big figure. Now it could be obviously I'm speaking in the highest probability. So in other words, if this big figure on the low end hasn't been traded to for several days or weeks, okay, you can reasonably expect a price bounce or reaction off of it. 20-30 pips is not uncommon, as much as 50 pips to retrace back into a mid figure. Now that bounce could come in the form of a SMT divergence bullishly. It could be a Judas swing trading down into a previous support level. It could be optimal trade entry from the previous day trading down into it with a confluence of pivots, figure, and fib. Okay, so there's a lot of things that come in conjunction with that, but the big figure level is a very target for reaction. Now price could retrace back into an optimal trade entry, and one could look to get long, maybe looking for a retest of the mid figure and ultimately the big figure level on the high end. There's your 100 pip swing that can unfold trading like this. Now when price trades to a big figure, obviously there's going to be a lot of profit taking because a lot of folks like the round number profits. 100 pips is 100 pips, guys. So we could reasonably expect price to trade off from that figure. Okay, now it doesn't necessarily mean price is going to completely reverse here and go straight down, especially if we're looking for a fractal to form on a higher time frame. Price would most likely swing higher. Why would it swing higher? Well, they're going to sweep above that figure level. Price doesn't always stop exactly on the round numbers. By using institutional levels like the 20s and 80s, we compensate for that static that typically takes place around the full figures. Because stops are placed above resistance or full figures, okay, this may reach above to 25 or even 30. Price then may retrace back into the range, taking out a previous swing low. Okay, and now the question is going to be is how do we trade from here? If we trade back up to optimal trade entry, that could be a likely candidate to get short, or it could be one more raid above that high that was formed right here. But if we're looking for just trading figure levels, you can use this as an indication to get short if you have a confluence of supporting factors that would represent sell zones and fibs, pivots, and the trader's trinity. So price could reasonably pay you on a slide down into the mid fig off of an optimal trade entry, and then bounce off of the mid figure level into a resistance level on a shorter time frame dealing range levels, and then ultimately reaching down for the big figure level again. Notice how price, we always have to anticipate a sweep below the low prior and the round numbers. Sweeping beyond it will take out any stops that will be resting just beneath that big figure level. Price could reasonably be expected to bounce at that level, 20-30 pips. Okay, so if you're a scalper, that's one way you could look for opportunities to get long and buy that. And price could retrace back down into the big fig as another optimal trade entry forms. Now at that low here, that could be an that could be a SMT divergence bullish, and it could be a higher time frame optimal trade entry. It could be a turtle soup, obviously, as is indicated here. One could look for a 20-30 pip bounce and reaching for the mid fig, but you also have to consider that this could be a higher time frame fractal forming, and this bounce higher off of that fig may be just reaching up into an optimal trade entry based on one of these swing highs here to get in sync with a higher time frame short. Okay, so you always have to base your trading not just simply because we're at a big figure it's going to bounce up and we can make 500 pips, or if it trades up to a figure we can sell it and make 200-300 pips there. You always have to consider where we're at in terms of the higher time frames and the overall market structure and market flow. But using these levels, one can really nail down some significant price swings and not have to be in front of your computer all the time. But you'll note that the key price swing highs and lows will always form at the critical kill zone times and session highs and lows. Alright folks, a great place to begin looking. When starting out, the impulse is to rush right in head first, and this is something I have always advocated against. You really need to determine a lot of things, not only about the markets, but more concerning you as a trader. If you're feeling rushed or have that itchy trigger finger to get in there and take a trade, be it demo or even worst case if you're a new trader live, stop. I don't care if you're trading Forex, stocks, commodities, whatever it is, if you're feeling rushed to get in, stop. Don't do anything, okay? Consider getting your feet wet slowly and building a trader's profile while you learn and hopefully earn a profit in the process. Slow and steady when you are developing is crucial. This style of trading can be used your entire trading career, not just as a starting point.